Welcome back to another episode of the Tip Share. This week, understanding the function of your restaurant's cash flow statement. Experienced restaurant operators closely manage the inflows and outflows of cash through their business. Sound management of available cash is critical for the ability to pay wages, keep the lights on, stock the walk-in, and make distributions to owners. The financial document that summarizes these transactions is known as the restaurant's cash flow statement. A solid understanding of this document is important not just for your accountant, but for owners and managers as well. Once you can interpret your cash flow statement, you're now in a position to more accurately project the future financial health of the restaurant. What is a cash flow statement? The restaurant cash flow statement records incoming and outgoing cash over a defined period of time, which is typically a quarter or a fiscal year. It also represents how the balance sheet and the profit and loss statement work together to impact your cash and operating accounts. Because restaurants don't operate entirely on a cash basis, it's often difficult to find your cash position from the income and expense statement and the balance sheet alone. Incoming cash includes revenue earned from sales of food and beverages, merchandise, rental income, as well as less common sources such as income from loans, financial assets, and investments from owners and partners. Outgoing cash records payments made for wages and salaries, operating expenses such as utilities and laundry service, and financial expenses such as payments of dividends. By accounting convention, the cash flow statement is divided into three separate parts: cash flows from operating activities, cash flows from investing activities, and cash flows from financial activities. How can restaurant operators use the cash flow statement? Operators can use the cash flow statement both internally and externally. For internal purposes, restaurant operators should review the statement every period to understand where their cash is going and where it's coming from. A few important questions to ask might include: were there any large purchases or loans taken out on the business during the period of the statement we're looking at? Was the operational cash provided enough to cover the large asset purchase or payment on the note? On the other hand, externally, it can be used by people like banks. They're going to use the cash flow statement to decide on the credit worthiness of the business. They may be looking to learn items like, does the restaurant make enough cash to cover its current liabilities through the operation? Or where exactly is that cash coming from? As we briefly talked about before, there is a relationship between your financial statements. Starting off with the cash flow statement. This displays the cash activities from both the balance sheet and the income and expense statement. It represents a combination of activities resulting from the daily operations illustrated on the income and expense statement, otherwise known as the profit and loss, as well as the overall activities and health of the business as represented on the balance sheet. The cash flow statement demonstrates the effect that cash inflows and cash outflows have on the cash position of the business. We'll dive deeper into the breakdown of cash flow statement throughout this video. Next up is the income and expense statement, otherwise known as the profit and loss statement. Reports on the day-to-day operation of the business for a set time frame. The P&L begins with all revenue from your sales within the restaurant. Not all sales provide cash to the bank the same day of the sale. As an example, an accounts receivable and third-party delivery services. The profit and loss will then subtract operational expenses from labor, food purchases, and direct operating, administrative expenses, and occupancy cost. While expenses may be recorded in real time as you pay your vendors, the vendor may not cash that check for several weeks. So while that expense is accounted for, the money is still in your bank. The amount left after the revenue and the expenses are recorded is going to be your net profit and loss for the business within that time frame. Lastly, the balance sheet, which represents the financial health of the business. The balance sheet begins with your assets, also known as what you own. Items such as your house bank, cash operating accounts, and large asset purchases such as furniture, equipment, and leasehold improvements. From there, your balance sheet goes down to liabilities, also known as what you owe. Items like your accounts payable, tax accounts, credit cards, and any long-term debt. The last part of the balance sheet will show any dividends, retained earnings, as well as your net income and loss. While the P&L and balance sheet are critical to understanding your financial health, they in themselves do not show the true impacts of cash. How do cash inflows and outflows really affect your business? Let's take a look at this chart here, and we'll start up at the top with the cash inflows portion. There's 3 different arenas that we can have cash inflows from. Operating activities, things like the cash that's received from food and beverage sales. Investing activities, if you sell assets or a collection of accounts receivables. And financing activities, receiving loans or selling stocks. Those all flow into the business. Now we're looking at the bottom half of this graph. We can see the cash outflows, things like cash paid for expenses, the purchase of assets or loans to others, and even payment on loans or the repurchase of stock. Those are all the outflows of the business. Now let's dive in and break down the cash flow statement even further. The cash beginning balance represents the total balance of all readily available cash accounts from the previous week's balance sheet. Cash flow from operating activities lists the transactions that form the bulk of cash flows for your average restaurant. Operating activities include the revenue generated from sales of food and beverage, merchandise sales, and rental receipts. Additionally, it records wages and salaries, purchases of inventory, and all the miscellaneous expenses of keeping the lights on and the doors open. It'll also account for changes in accounts receivable and accounts payable. The next line to look at would be the net profit or loss. The net profit loss shown on the cash flow statement isn't what's reflected in your bank account. In the snippet example below, expenses exceed revenue for the period. However, year to date, there is still a profit. Up next is assets. Assets are what you own. When there is an increase in assets, there is a related decrease in cash flow. An example would be something like inventory on the shelf. That's money that's not in the bank. So an increase in the inventory asset is going to be a decrease in the cash in the bank. Liabilities. Liabilities are what you owe. When there is an increase to liabilities, there is also an increase to cash flow. An example of this would be gift cards are an increase to cash when they are sold, but a decrease when they are redeemed. This is important to consider when forecasting cash flow during those slower months of your restaurant. Investor activity. Cash marked under investing activity covers changes in assets, things such as the purchase or sale of land, the purchase or sale of equipment, loans to vendors, and changes in holdings of stock and security. In your average restaurant, you're most likely to see cash out transactions in this section of the cash flow statement for expenses like kitchen stoves or kitchen refrigerators. When there are increases in Inventor activities, there are decreases to cash flow. An example of this would be leasehold improvements will decrease cash to pay for those improvements. Forecast preventative maintenance schedules and large expenses when forecasting out cash flows for these types of expenses. Financing activities. Investments from partners and owners, as well as payments of dividends. This is what's all going to constitute financing activities. This is where direct investments of cash into the business show up, as well as withdrawals or distributions to the owners. When there is an increase in financing activity, there is also an increase to cash flow. An example of this would be a loan brings money into the business, increasing cash, but also increasing liability. Consideration should be taken into the payment of the loan versus available cash flow, especially if the loan has a variable payback schedule, mob loans, and advances. Your ending cash balance. How are these numbers generated? Well, an increase or decrease in cash represents the total increase or decrease of cash resulting directly from operating, investing, and financing activities. The ending cash balance, however, showcases the total readily available cash from the current balance sheet. How is the cash flow statement calculated? There are two approaches to the calculation of the cash flow statement: indirect and direct. Let's start with direct cash flow calculation. This can be as simple as summing up all of the positive and negative cash transactions in each of the three sections of the cash flow statement. It can also be measured by the changes in your assets and liability accounts. This cash flow method is used by businesses that are run on a cash accounting basis. The other side is the indirect cash flow calculation, which involves making additions and subtractions to the income statement based on cash and non-cash transactions to arrive at your cash flow statement. For non-cash transactions, your accountant will consult your balance sheet, recording changes in assets and liabilities. This indirect method is mostly used by companies that run their accounting on an accrual basis. The foundation of restaurant cash flow analysis is accurate data on your cash inflows and outflows. For restaurants, that mostly means food and beverage sales for the inflows, and wages and operating expenses for outflows. To a large extent, this data lives in your POS. To make quick work of your cash flow statement, you want restaurant accounting software that integrates with your POS to pull out the data for easy categorization and review. RASI software is notable for excelling at this exact function. But beyond POS data, a cash flow statement requires tracking your accounts receivable, AR, and accounts payable, your AP. Ideally, this information should reside inside the same software suite used to analyze that POS data. An integrated restaurant accounting solution puts your AR and AP transactions alongside income to give you that comprehensive overview of your accounts. The next puzzle piece in the financial picture of your business is payroll. Recording the wages and salaries you pay is a large part of those cash outflows that fall under operating activity section within the cash flow statement. A properly comprehensive restaurant accounting solution, like RASI's, will manage your payroll as well. So this is how software can solve all sorts of problems, all under one roof, all with one software. How does your cash flow statement help with your restaurant's profitability? Well, as we've talked about throughout this video, the cash flow statement for a restaurant is a concise summation of the use of cash by your operation. It records whether your cash inflows are larger than your outflows, which is key for profitability. And it also shows you what funds are available for investment in the business, such as equipment purchases. The cash flow statement is also a very useful gauge of whether you're generating enough cash to undertake expansion, as banks will want to see healthy cash flow from your main restaurant before approving any loans for additional locations. Your cash flow statement is a regular measure, in conjunction with the income statement and balance sheet, of the evolving quality of your finances. As a group, these financial statements enable restaurant operators to make fully informed operational changes that can help drive profitability back into the business. Now that you know how critical the statement of cash flows is for a restaurant, how do you choose software to keep on top of your cash flow? To easily calculate your cash flow statement, you need a complete solution for restaurant accounting. RASI's comprehensive software integrates that POS data that we need, inventory, accounting, payroll, cash management, and operational metrics, all eliminating manual data entry and giving you a single point of access to your restaurant's data. RASI is the choice of thousands of restaurant operators across the country. When you sign up with RASI, a dedicated accountant team will onboard your management staff, configure the software to match your operational flows, and coach your team on how to use the software to set and meet financial goals. You can always contact us to get a free demo of the RASI suite at rasiusa.com. We did it again. That's this week's episode of the Tip Share, and as always, we'll see you next week.